Hello, this is Mike Swanson of WallStreetWindow.com. I'm speaking with Ike Iossif, who runs the website MarketViews.tv. How you doing today, Ike?
I'm doing well, Mike. How about yourself?
Oh, I'm doing good. Thanks for joining me. We've spoken many times this year about the trends in the financial markets, and I don't think we've spoken since the election of Donald Trump and this big rally that's taken place in the U.S. stock market, which is something else. It took everyone by surprise, I think. I don't know anyone who was saying the market could go up if Trump won. I didn't think that myself, and until I said, "Whoops," a day or two later, and made changes. But what do you think is happening now? Do you think this can last, or what's your analysis telling you?
Mike, let's go back to what we said a couple of months ago. The last interview we did was on October 14th, and at that time I said there were two scenarios. Okay, the first one was that we could see a further deterioration going into the end of the year. And the second was that we would see an intermediate term bottom in about 1 to 3 weeks that would lead to higher prices early next year, between 22 to 23.50. And I emphasize that at that moment, scenario 2 was the most probable. And lo and behold, that's exactly what happened. The market did bottom exactly 3 weeks later on November 4th. And so far, it has run up to 22.80 at the highest yesterday, which further supports that we will see 23.50, early next year, and perhaps maybe we'll overshoot and we'll see 2400. I can't talk about with much certainty about this right now, but the goal of 23.50 is not that far away, and the markets sometimes have the tendency to overshoot or undershoot. So it wouldn't surprise me for the market to overshoot and from 23.50 to reach 2400. The question is, what is happening? Whether is the beginning of a multi-year bull market because something has materially changed in the economy that will support for the next several years higher corporate profits and therefore higher stock prices. That's the real question. Okay, now I have some thoughts about this both on the fundamental basis as well as on the technical basis.
Okay.
Now, fundamentally speaking, there are two things that you cannot argue with will be beneficial to the economy and the market, and that is lower corporate taxes and lower capital gain taxes. Okay, the question is, how much can stock prices benefit from that? I think they can benefit some, but I don't think at current valuation levels they can benefit tremendously. At the same time, we're in an environment where we're seeing higher interest rates. If you look at all valuation models, they all show stocks to be grossly overvalued, except one. That is models, except the ones that are correlated to interest rates. If you compare stocks to interest rates, until about 5 weeks ago, they appear to be, neutral to slightly overvalued. But now, with interest rates rising, even that is gone.
Right.
The thing about overvaluation is that it is not a timing tool. Just because the market is overvalued, that doesn't mean it's going to go down. And if you look at the recent history, the markets were overvalued in 1997. They continued higher until 2000. The markets were overvalued in 2005. They continued to go higher until 2007. Okay, so valuations are not a timing tool, and this is important for people to understand. But what I'm getting at is they also are not the if you're already overvalued, you're not starting a new bull market. Okay, I've never seen a new multi-year bull market starting from a point of overvaluation. It's a continuation of an existing market. Okay, and if you look at the technical picture, and for the purpose of continuation, I have the same charts we posted last time we talked, and there are three sets of charts. The first set is the AD line for the Dow, and right next to it, the cumulative volume. Now we can see, very clearly right here that the AD line has made new all-time highs. Okay, but the volume is lagging. The interesting thing is the Dow has been the strongest index of all, correct?
Oh, for sure. It's
and
amazing.
Look at cumulative volume.
It hasn't made a new high.
Marginally.
Yeah.
Okay. The thing is, at the beginning of new, multi-month or multi-year bull market, you see a sharp expansion of that. You see a sharp expansion in volume. You don't see just marginal new highs.
Right.
If you look at the S&P, okay, we have a very sharp rise, and the same thing holds true. Okay, if you look at the NYSE, but it's not the same thing for the NDX. Okay, so what you're seeing right here is a bifurcated market. Bifurcation is not, again, a sign of a new bull market. In multi-month, multi-year bull markets, one of the things that you see is uniformity, not bifurcation.
Right.
Okay, and what we're seeing is bifurcation. We're not seeing uniformity. And again, I want to make this very clear. That does not mean the market is going to go down. No, it can continue higher. I've given you a target up to about 2350 a couple of months ago. Okay, and I said it could overshoot. But my point is, we're not going to see Dow 25,000 or the S&P at 3,000. Okay, because neither the volume nor the AD data suggests something like that. What it suggests is we're seeing a continuation of the bull leg that started back in February.
Right.
Okay.
Well, would you agree with this statement? Let's just say, for the sake of argument, that the market's going to go up for 5 more years. Is it would even if that were to happen, would everything you're saying suggest that on that way to 5 more years of gain, this rally that we're in now will come to an end, and there would have to be a violent correction first? That this current technical condition is going to lead to eventually at least a correction, maybe a new bear market. It's not going to go up for 5 years in a row.
No, I do not believe that. I mean, it could go up for the next 5 weeks or the next 5 months.
Sure.
I doubt the next 5 months, but the evidence is not there that it's going to go up for the next 5 years or even for the next 3 years.
Yeah.
Okay. Something else about corporate profits that people need to keep in mind is this. Okay. If your profits are increasing, that gives you the opportunity to lower prices in order to gain market share. Okay? And most corporations go for market share. What that means is when you get lower corporate tax rates, initially you will get a rise in corporate profits, but for about 6 to 12 months. However, a year later, collectively corporate profits will go lower because some corporations initially will choose to lower prices in order to gain market share, which lower their bottom line, okay? And soon they're joined by other corporations. So yes, initially you do get a boost, but longer term you don't. And that is why I don't see a permanent boost in corporate profits at these levels. Which is the reason why I'm saying, yeah, we can see higher prices for the next 5 weeks or the next 5 months, but not for the next 5 years.
Right, right.
Okay. Now the next chart we have, which is the NYSE new highs, new lows ratio. Again, at the beginning of multi-month, multi-year up legs, you see an expansion. Now look at this chart. Does it look to you that this is expanding or it is contracting?
No, it's contracting, and I think we've seen that too with a lot of the sluggish trading in a lot of stocks. Like Amazon or Facebook or a lot of the real popular stocks have really lagged on the rally lately. Since the past 6 weeks.
Well, take a look at the next chart, which is the weekly chart of the VIX. Now, the VIX can stay low for quite some time. And you can see the multiple lows that we have had since 2013, okay? And then we have had even lower lows in 2007, I apologize, okay? You can see the arrows on the chart. The point is, when did we get a multi-year rally? We got that, okay, when the VIX was up above 40, okay? The most we managed is 22 in the most recent decline, okay? Again, that's not what we see at the beginning of multi-year or multi-month rallies. You get that, for a few weeks, but not for several months or several years, okay? And then from there, we go to the next set of charts, which is the number of stocks above the 50, the 150, and the 200 moving average. Again, we don't see an expansion, we see a contraction. And that tells me that what we're seeing is not the beginning of a new multi-year bull market, but a continuation of the bull leg we have seen since February of 2016.
Mm-hmm.
And the next chart we have, which is the chart of the SPY, courtesy of a decision point. Again, I want to, point out that we got the first price momentum oscillator divergence, okay, or crossover in 1998. And then from there, we had the very sharp decline. The market continued higher into early 2000. We got a second crossover, and then the market continued higher until September of 2000, okay? So the fact that it continues higher, it doesn't mean that we have seen a multi-year technical buy in the price momentum oscillator. The buys in 2003 and again in 2009 came from the negative 0.75 area, okay? Look where we are right now, okay?
It's going on for a long time.
Yeah. So again, what I'm saying is, if we were to see, the monthly PMO, below -5, I would say, yeah. I mean, this is where we have known multi-year bull markets to start. Right now, that's not the case. Okay. In fact, we haven't even had a positive crossover. Okay. And the The last chart that I have is our our own proprietary inflows outflows analysis chart, which we have not shown for the last year. Okay, um, what these charts represent, their proprietary indicators measured on a 25 and 50-day basis of the cash flows, inflows and outflows into the S&P 500 stock components. Okay, the black line represents inflows and the red line represents outflows. The green line, the horizontal green line, is the line at which inflows equal outflows and the market is at equilibrium. In other words, neutral. Okay,
Right.
when inflows exceed 50%, it means there are more buyers and that's supportive of higher prices. When outflows exceed 50% of total cash flows, it means there are more sellers and that's supportive of lower prices. Okay, and I use a 25 and a 50-day moving average filter to examine short-term and intermediate-term tendencies. Now, if you look at the 25-day DMA, okay, we see that we are above the 50% mark, okay, but we're very close to the point where we also see the exhaustion. Okay, near about 65% is when we see the exhaustion. Right now we're about 59. Okay, so it doesn't have very much to go.
Right.
In addition, if you look at the 50-day DMA, you can see the sharp divergence that we have. That's not what you see at the beginning of new multi-year, multi-month, bull markets. So that tells me in the next few weeks, more than likely, we will hit the target of 2350 that we had given 2 months ago. And I wouldn't be surprised to see that target exceeded, go up 2400. But beyond that, I think the market will have a very hard time making any additional progress. I mean, I see this move as a continuation of the bull leg, of the up leg we had starting back in February of this year. I don't see it as the beginning of a new leg like the one we had back in February. I think it is the last stage of the same up leg.
Right.
Can carry us to 2350 and maybe overshoot and go up to 2400.
And that would mean when it's over, you either get a bear market or a correction. That's the question for later.
That's early to say. Okay, I would dare to say that we'll probably get a bear market, but again, it's early to say that. But I will dare to say one more thing: if we do get the bear market, right at that point, I do expect the decline to be in the 40 to 50%.
Whoa.
So if you are 2400, that puts us down to roughly 14 to 1200 in the S&P.
Well, one thing about a bear market too is if you look at the summer of 2000, the Nasdaq topped out and was terrible, but the S&P made a new high in the fall. And the point I want to make is once this thing goes, I think there'll be a transition into a bear market in which the kind of the same thing may happen, where the tech stocks and all that stuff does terrible for a few months, while the Dow and the S&P can still do okay, or maybe continue to make new highs or something. That's kind of my guess of what will happen whenever we get to that point.
Like I said, the thing is, I mean, do you get positioned for a multi-year bull market, or do you get positioned for a transition into a sharp correction, or even more seriously, a bear market? And I believe over the next few months, you get positioned for a very sharp correction, and more than likely a new bear market. So,
Well, and
the point is, look, I talked about the S&P is now at 2350 2 months ago. We talked almost 2 years ago, January of 2015, about three tops and a dome. And back then, if you recall, I had said that to get a dome in the price structure that we were getting back then we will have to see a rally in the S&P virtually above 2250, which is what we're getting. So I think there is consistency, in my view, based upon my observation over the last couple of years. So, 2 years ago, I talked about three tops at the home and a rally above 2250. 2 months ago, I said we were looking about 2250 to 2350. And as I said, the market could overshoot, but I don't see this as the beginning of something big. I see it as the ending of something big, which is one of the biggest bull markets we have had beginning in 2009.
Well, we'll have to, keep looking at the trends and the charts to monitor the changing points, the turning points, and keep in touch and do more interviews as next year or this year continues.
Definitely.
Well, thanks again for taking the time to talk to me and everyone else and share your charts and knowledge of everybody.
You're welcome.